Hi, my name is Tracy Lenz. I'm a petroleum engineer and owner of Pecan Tree Oil and Gas. Today is just a real quick video to give you a feel for how to look up yourself if oil and gas prices are going up or down. Because a lot of times I'll give feedback and I'll give my reports saying, here's the prices that I used for this report. And then if you're looking at this a couple months or years, even in the future, if prices are up, then the value's up. And if the prices are down, then the value will be down. But how do you actually know what's going on? So I'm going to show you the inside scoop of what I'm looking at when I'm grabbing prices and when I'm kind of seeing what to use in my models, just getting my feel for what the news is doing. So with that, we're going to hop into just a couple websites and I will link all of this down below. Make sure you subscribe. I'm putting out more videos more frequently. Hopefully y'all notice and stay subscribed and we will journey through this together. We're going to take a look at natural gas pricing. And so I'm here on the EIA website, and that is something that the Energy Information Administration puts out for free. And so this has a lot of data on it. And just take a little bit to explore this website if you've never seen it before, because there's a lot of news and pricing and market information that the government is tracking for us because it's part of, energy security and yada, yada, but you can use that for your own purposes. So right now I'm on natural gas pricing. So this breaks up natural gas into several different types of places it's priced. So there's the wellhead price, which is what y'all are probably most used to because that's what's on your statements. So if we go into prices, then we can see what you're looking for is this natural gas spot and future prices. So spot pricing means at a spot in time or a spot like at a certain place. Like you can't go and find this gas for sale all the places all the time for this price. It's not like a candy bar that's priced at a certain amount everywhere you go to the store. This is at a certain spot, at a certain meter, at a certain point in time, the price. And it's used like as a apples to apples, like it's always measured at the same spot on the same day, just to be able to see if prices are going up and down. A lot of times that's Henry Hub, which is a gas hub, trading hub in Louisiana. But there's other gas hubs and places that spot could be at. And so you need to look to see which spot you're looking at if you're trying to compare apples to apples. So we're going to click on spot and future prices. And so here we have that Henry Hub spot. And so like I said, Henry Hub is a hub in Louisiana that this is the spot in time at a certain point of the day. And there's a lot of details as to, official daily closing prices at 2:30 p.m. There's a lot of different places that you can grab these prices. So if you're really interested, there's a lot of details, but we're probably not interested in that much detail today. Here is the dates going across the top here. So May 3rd, 4th, 5th, 6th, 9th, because it's not open on the weekends. And so 10th, and then you can view the entire history all the way back to 1997 by clicking on this link here. So this is what the prices have trended the last 5 days. And you can click on that link to see all the way back to 1996 what the pricing was doing. So you can see we are on a ramp up, and that is what the news is all about. If your asset is a majority natural gas based, like if most of your payments are coming from natural gas, say if you're in the Marcellus Shale, if you're in the Haynesville, East Texas area, if you're in a very gassy part of the Permian, some parts of Oklahoma are very gassy, some parts of Bakken are very gassy. Just the areas, you should know if you're getting paid, if most of it's coming from the gas stream or the oil stream, because most wells do produce oil and gas. So if you are a gas majority, then your values are going up. So this is just a point in time, but we don't value assets based on just a point in time. We value based on what the projection is for that commodity. So if the commodity is projected to go up, the value is going to be higher than if it's at the same spot price but projected to go down. So the official terms for those are backwardation and contango. We aren't going to look at those. We just know that there's a future pricing that goes up and down. We can go into more detail on that in a future video, but for now, just know that there's something called futures. So along with the spot price, there's kind of two things that we're combining together to get a view of what commodity pricing is valuing assets that produce those things. So there's the spot price, which is what it is today, and then there's the trend that's projected up or down. And for gas, honestly, it's a wiggle, so expect a wiggle. And what that is, where you can see that is if you go to something like, I'm on Yahoo, Bloomberg, all the different places that you can see stock prices usually have natural gas and crude oil as a commodity that you can see. So I'm here on the natural gas commodity page, and this wiggle here is the same that we've seen prior, but this is like how it's moving in just one day. If we go to the 5-day trend, 1-month trend, this is all the things that we were seeing on the EIA page, but just summarized into one place. So day traders who need gas or will need gas in the future, say to power their plants or something, are buying things ahead of time. So if they know that they're going to need natural gas 10 years down the road, they're going to hedge their bets and buy things ahead of time and set a certain price. And this is all the very non-technical explanation of what's happening, but it's being traded back and forth. And that's how the price of gas is being set. It's not the companies setting the price. It's the people buying the gas that's setting the price. So the more people wanting to buy, the higher the price goes up, same as if there's more people wanting to buy stock at a certain company, say like Tesla or Apple, that will go up. But if nobody's wanting that stock, it goes down. So that's how the price of gas goes up and down. Same with oil, actually. So here we have the historical, so what things traded for. And this is where you're getting, so at a certain, on this day, that was the spot price. This was the spot price. This was the spot price. But if we're wanting to look at the futures, there is a tab on most of these sites called futures. And then we can click and see each one of these contracts is what that gas will sell for that month. So you combine all these different contracts together, and that gives us a future trend for what oil and what gas will sell for. And so if you'll see here, this 7.714, 7.818, whatnot, that is all saying what someone's willing to pay for gas that far down the road. Now, this is an extremely hard way to view this data. So what I do is I pull it into an Excel file so I can see it better. And so I'm going to switch over to that. So here is an update. Let me refresh this so we get the most recent data. Take a drink of my coffee. There we go. We saw an update. On this chart, this is commodity price forecast and historical for oil, green, gas, red. So in the industry, in the US at least, the typical colors used is green for oil, red for gas. And that's mostly because historically oil was good, red was bad for gas because there was no market for gas, but now there is. So, but we stick with trends, and so green is oil, red is gas. So I have on this plot here the spot price for oil and gas, so $7.64. And so that is for, let's see, 5/11, May 11th. I have the spot prices on here. So, oh yeah, here it is, right here. So this, from this little X forward, is the futures that natural gas is trading for. So if you see, it kind of wiggles up and down. Those bumps are the winter months. So people expect gas to be in higher demand in the winter, so they expect it to trade higher in the winter. Oil is a more steady supply just because it's not weather driven like other commodities. But this is what we're looking at when we're seeing what an asset is, like an oil and gas mineral asset is valued. We have the spot price and the futures. And then you combine that all together, and then you can project how much royalties will come off of that asset into the future. So as we know, or as a lot of us know anyway, oil and gas does not produce all at once in one. You don't go in and just pump out all the oil in one day. It takes months, years, decades to get all the oil out of the ground once you start producing it. And so this is something that once you start producing it, you're going to be getting a revenue stream for a very long time, usually. So that's why we need to combine these future pricing into with the future production profile, which is what we do as an engineer, is project what these wells are going to produce. And then you combine those things together with a bunch of other equations, and that's how we come up with the value. So if I said that your report was based on $100 oil, you might look at the spot price and say, well, 105 is higher than 100. So my value must have gone up. Not necessarily. So if you look, it is projected to go down. So the market's saying that, hey, we saw an increase in pricing. Spot price today is up, but we don't think this is long term. Over time, we expect oil prices to go back down. And so what that's showing us is that if we go over to crude oil, so I'm on the Yahoo page for crude oil. If I hop over to futures, we see it go from 106 down to 80s, 82, 79. It goes down in the future, and that's just the market expecting it to go down. And then also just pointing it out, spot prices for oil is documented on the EIA just the same. What you have to do is combine the future forecast with the spot price. And so what I do is I take a discounted method to come up with what like an approximate average price is, because I don't want to average all of these points and just run a line through the middle, because the stuff that is sooner is worth more than the stuff further away. Because if there's the time value of money, if someone could give you $100 today versus $100 10 years from now, which one's worth more to you? Well, the $100 today, right? You can invest, if nothing else, you could invest it in a bond, right? And like something as simple as that, or put it in a savings account and even just make a couple cents on it versus getting $100 in the future. So just intuitively, you know that money today is worth more than money later. And so that time value of money is what the discount factor is. So the discount takes into effect that how much you could have made if you had it today versus tomorrow or 10 years from now. So if you expect to make 4% interest on that money, then a discount factor of 4% would be appropriate to get it to convert 100 years from now to today. If you expect to make 10% on it, a discount factor of 10% is what you'd use. So typically the market uses 8 to 10% to discount things back to today's value. For riskier things, you can go up to like 12%, 20%, 30%, but somewhere in that 8 to 12 is usually a good starting point. And then also these wells just make more in the beginning versus the end. So just volume weighting it, like the early time will be higher in terms of profits and volumes. So in my reports, I'll give you a weighted average, a discounted weighted average of oil and gas pricing. And that is what this is doing. So we have $81 equivalent and $4.96 for gas equivalent. And that's versus a spot price of 105 and 764. So you can see there's quite a big difference between spot price and the weighted average, but really that weighted average gets you more of it. So if we look at 81.70, here's the $80 line for oil. So that puts us right about here. If like that is about average of what you're going to be expecting over the life of something that's producing today. And then for gas, we're looking at 496. So on this side of the chart is the gas axis. So 496 is about $5. So here, so that's showing we're riding right above that line for the average for the future. So that's how I'm comparing pricing. If nothing else, you can always just take the plot that I provide in my reports that looks just like this and compare it to a futures price, a futures strip on that Yahoo chart, and see like, okay, well, in May of 2024, what was gas projected to be? Higher or lower? Okay, higher, well, then value probably went up. Because this is the most important factor in what your asset's value is the commodity price. So that's why we're focusing so much on this today. I want you to be able to find this yourself. So I'm going to provide these links in the description below. Again, make sure to subscribe to get more details in the future on this type of information. I want to be providing things to you so you can take this into your own hands and know what your asset's doing without having to reach out to any person who might have a bias in swaying you one way or another. Like, you can go straight to the source and find what's happening without having anyone kind of clutter things for you. So hopefully this was helpful. Let me know if you have any questions. I'd love to help you. My contact information is down below, and have a wonderful day.